Hello everybody, testing audio, everything is clear, and we'll be able to start with the webinar. Thank you to everybody who is tuning in to this webinar with XTB. We're gonna be talking about the gold market and what has been happening on the gold market for the past few weeks. My name is Walid Kudmani, and I am the market analyst at XTB UK for the Italian and Arabic market. And today we're going to be talking about a few things that have affected the gold market specifically. Why there was such a sharp drop in the price of gold, and a few factors to look forward to moving forward, in addition to a few interrelated markets, a few updates that have been happening since some of this data that I'm about to show you came. So first of all, we have our disclaimer. Of course, this presentation is provided for general information and marketing purposes. Is my opinion. I'm not giving investment advice. I'm just going to be outlining some information, and hopefully, it clears out a little bit of what's been happening on the markets in such an uncertain time, and in such a unique time that we find ourselves in nowadays. The world and is signaling a severe economic slowdown. Of course, many of us have been feeling the effect of that. One country after another has been shutting down. This obviously will be impacting demand as well as supply, because people are stuck in their houses, so they can't buy anything, and producers, some of them can't get their raw materials or their components, and so supply has been affected as well. In response, the market sells less secure assets, and the precious metals market behaves the opposite of what would normally be expected. So what would normally be expected, of course, would be, as a safe haven, traditional safe haven asset, gold increases in times of financial stress. So people, they see the stock market, dropping, they invest their money in gold, and they hold out. They think that it will buy them some safety for a period of time where the stock markets or traditional risk-on assets are not as profitable or as safe. We also have gold, silver, and platinum were sold out due to the need to cover other losses and the need to top up deposits on other positions. So that was one of the main topics that I'm going to be talking about, as well as one of the main factors behind the big sell-off in gold that we've seen over the past few weeks. Gold has recovered since, but we'll get to that. So the issue there, I'll get to it more specifically, but basically people realized that the markets were dropping so much, their positions were being closed, and they had to sell anything they had, including safe assets like gold, silver, and platinum, to be able to keep their positions from closing and from margin calls. At present, of course, we can see central banks printing cash. So cash is the most desirable asset among investors. Gold fulfills its task of being an asset available for quick sale at the end of demand of cash. That goes back to what I just said. The fundamental situation at the end of last year showed excessive optimism in the gold market. There had been a steady increase, although, as I will show you in some charts, there was some overbought conditions, and that reflected poorly as soon as the fundamentals changed. At the same time, a further increase from the investment demand is an opportunity for gold, because of course if the price drops, there's going to be an opportunity for investment demand. And as I'll show you in a chart later on, positioning on gold has long shown an overvaluation. On the other hand, only the reduction of the long positions can be seen. So people stop going long, their positions on short tend to be still open, or they still hold their positions on gold. The total sell-off on platinum and silver markets that occurred a few weeks ago, that now has been continuing over. And of course, we have the website here for the info at coronavirus to check out the latest numbers. So let's move forward. Here we have a chart that shows the U.S. interest rates and the price of gold. So the U.S. interest rates is the inverted yellow line, and the price of gold is the white line. You can see that as the price of gold increases, so the rates have been decreasing. and they actually met here at around 1532. So we can see that there's always this convergence, except for in these periods where severe divergence between the price of gold and the low. So the low interest rates suggest cheap money and higher gold prices. So if money is cheaper, people tend to be able to buy more assets, and that raises the price. Cheap money stimulates investment demand for gold. Of course, if people are able to procure themselves cash with lower interest rates, they're able to invest it both in risk-on assets as well as risk-off assets. Cheap money also stimulates the investment demand for gold, as I said, and the strong rebound of speculative demand can be seen. So there had been a significant drop-off speculative demand, and as of late there has been a severe, quite marked increase. And you can see the ETF purchases, so exchange traded funds, had a slight dip and then have been increasing ever since, obviously because the prices drop. Of course, I'd like to remind that past performance is not necessarily indicative of future results, but it's good to keep an eye on history because, as we know, history sometimes tends to repeat it. Here we have another chart, well, from Bloomberg. We are currently observing a huge increase in demand for cash, as many of you know. Governments around the world have been struggling to print as much cash as much as possible, offer competitive loans, offer quantitative easing. Every government, every central bank seems to be pulling every stop, and it doesn't seem like they are concerned at the moment about how they're going to deal with it after. But this is due to the fact that when the economy halted, there is no movement of cash, so somebody has to be able to provide it. And whether it is from selling these assets people were holding for a long time, or whether it's from low interest rate loans or grants, or however each government might approach it, there's seen across the world this huge demand for cash, which, as many of you may know, most things around the world are quoted in dollars. So dollars tend to be the world currency, and that tends to be most in-demand currency, which is why we saw a rally for the USD against pretty much every single currency over the past few weeks, to where like cable reached down to record levels. Euro USD was at record levels. Every pair with even USD yen, where all of them, because of the strength of the dollar, that was high in demand. It can also be depicted as a clear decline in US bond yields, which also coincides with the dollar strengthening, as I mentioned. Similar situation occurred in 2008, which many of you might be asking yourselves, how does this compare to the situation in 2008? And as we move forward with the presentation, I will be outlining some differences and some similarities. So far, the situation at the time normalized shortly after, and gold began to gain. And as we've seen ever since, basically over the past maybe week or so, few days, gold has been rebounding slightly. The chart shows that yields on 10-year US bonds, obviously borrowing US debt, and which is the yellow line, and the price of gold, which is the white line, and the US dollar, which is the green line. So you can see that the dollar is decreasing, which is inverted, meaning it's increasing, and we can see the relation between all three of them now since its max. And this is similar to the situation in 2008, where there was a huge divergence. This data is slightly older. As you can see, it's from the 16th, so unfortunately we've seen a lot more cases around the world of coronavirus, despite in China them being decreasing. But the predictions mentioned that the increase in China at the time, the increase of affected cases outside China causes usually panic among investors, because a lot of investors tend to assume that China is a self-contained economy that isn't too reliant on other countries to for their GDP, other than of course all the exports they do. But if they are affected without affecting the production lines, then the world is not as concerned. Although, on the other hand, if anything happens in the Western world, like in Europe or in America, investors tend to worry a lot, because that's where a lot of their actual stocks are held. As you may know, most people invest in major markets and indices and stocks that are usually in the US markets or the European markets, whether it's the DAX or the UK FTSE or something similar to that. So investors are always keeping an eye on not only the economic data, not only the these kinds of charts where obviously you see divergences and bond yields, but you're also keeping an eye on fundamentals such as number of cases. Because if a country that, for example, you have stocks in shuts down, then you never know how that might affect the industry, the market, and the stock market as a result. Of course, the government, how they handle it, would also affect all of that. Based on those estimates from March 16th, it was predicted that the number of cases in Italy within 2 weeks may exceed those in China. I'm not sure if that's the case yet, but I know that the number of deaths have exceeded those in China, at least the reported deaths. And so, of course, the situation is very sad, but Italy has gone through taking extreme measures into containing and preventing the further spread. And I think over the past few days, it seems like the number of new cases has stabilized. Moving forward, we have that the U.S. Financial Conditions Index tracks the overall level of money, bond, and equity market conditions, and allows to assess loan availability and costs. Positive value indicates general availability, accommodative conditions, while a negative value indicates very strict conditions. The recent declines means a huge demand for cash. This was behind the gold sale, as I've mentioned. Shocking here, of course. So we have, if we go back and look, this is from Bloomberg, a very nice chart we can see here. We see that there's generally steady conditions. Then we have the 2008 financial crash, where, of course, since this tracks the overall level of money, bond, and equity market conditions, we can see that everything crashed. So everybody was short for cash. At the time, it was a subprime loan crisis, so people were obviously struggling to pay their loans. Demand for cash was high. People lost their jobs, and we all know how that went. This time, we have a similar thing happening where there was a long period of extended stability, or roughly, but now we've seen a massive decline in these conditions. And this is from the 17th of March. Now it's the 25th. Moving forward, I'm not sure how things will continue, although as days go by, there's more and more cases of coronavirus being reported inside the US and, of course, outside the US as well, states, and the spread is being contained basically on a state-by-state basis. People know that they're struggling with all sorts of equipment and resources that they need, whether it's like protective gear or actual respirators and ventilators or just hospital beds. So moving forward, of course, the situation can evolve day by day, but if these estimates are based on the 17th, nowadays there's more cases. We can assume that the conditions are not as good. Although the central banks, like the Fed, has been intervening and has issued several rounds of QE, including the most recent one, which was an unlimited, basically QE, quantitative easing, for those of you who know. And they have said, basically every central bank around the world and every government has said, we will stop at nothing to save the economy, to save or to limit the impact as much as possible. So we are truly, this is different, but now we are in unprecedented times, because I don't think in my lifetime I've seen something where the whole world was dealing with exactly the same issue, and something that everybody can relate to nowadays. Forward, go to this chart, which shows a few different things. So we can see the ETF positioning, and a clear reduction of long positions. It is worth looking at what happened in 2016. Here we have the reduction. And an analogy to physical demand. So physical demand also decreased, and the fall in gold prices in 2016 was 15%, with a strong reduction in long positions. It is worth noting that number of short positions is also falling, which means no change in the fundamental outlook. Positions for 10, so from the 10th of March, currently net positions are probably much lower. The white lines refer to long positions, yellow to short positions, and the purple lines mean net positions. Green is the price of gold, while red is the amount of gold held in ETFs. So there's a lot to take in this chart and in this graphic. We can see that obviously long positions, short positions, white and yellow. So long positions have dropped, but also have short positions. So one would assume that, you know, if the market is going badly, usually the long positions drop and people they tend to follow the trend. So if it's going down, they'll increase the number of short positions because they see a downtrend and they want to get in on the market. However, nowadays we see differently. We see that the number of and that can actually be seen in several examples. For example, here where like the long positions drop, the short positions. But here we can see that everything is decreasing, meaning that, going back to what I mentioned earlier, there is just a very high demand for cash. And so everybody's closing everything they have, even selling physical stocks of gold, and which, of course, led to the drop in price. Because if everybody's selling and nobody's buying, then fundamental laws of economics and demand and supply indicate that usually price decreases. We can see that also the net positions, so the difference between long and short positions, has also been decreasing, meaning that it's evening out more slightly. And we have had a fairly steady increase in the price of gold for the past 2 years, maybe since 2018, and even not that much of a change from 2016. But now there has been a very deep drop in the price of gold, and it was around 15%. And it was all sudden, and it caught people off guard. But once the initial rebound happened, it seems like the prices have stabilized. I will be switching to the XStation platform after to show you like current numbers and where we are at right now with the price of gold. But for the time being, we'll just focus on these slightly for like a week ago. So here we have the QA from the Fed, the ECB, and the Bank of Japan in billions of dollars. Quantitative easing is basically how much money the central banks / governments introduce into the economy to help and stimulate the economy and provide either competitive or interest-free loans to banks so that they are able to lend money to private banks or private individuals so that the business and the economy can function. So interest rate cuts and huge QE programs from the largest central banks in the world will lead to access to very cheap money. As we've seen, basically every central bank has cut rates by first, not in one go. So we saw some central banks start with like maybe a 0.25 or 0.5 basis points drop, and then the Fed decreased it to some of the lowest it's ever been, almost zero, which is I think 0.25 now. The Bank of England decreased the interest rate a few times, and then most recently from 0.25 to 0.1. And all this is doing is basically allowing people to not have to sell everything they have in order to get access to cash, so that they can stimulate the economy both on derivatives and on real markets. Meaning that if you have if you don't have to sell your gold because you're allowed to borrow money at very competitive rates, or even sometimes at no rates, and we have some governments around the world that have like negative interest rates even, meaning that they will pay you if you're an institution, then we can see that governments are trying to do everything they can so that not everything is on sale on the market and everything drops together. So they'll provide more money in order for businesses to feel more confident and be able to function in the economy more not so one-sidedly. And we can see that basically there has been a spike in everybody's action, whether it be QE or interest rate reductions. So here we have an interesting chart that shows us the split of gold demand between jewelry, technology, investment, and central banks and other institutions. The interesting thing about this is it shows that when 2008 happened, central banks and other institutions completely gave up any gold they might have had, and we saw that around 2011 they started buying more and more of it, and became a larger part of demand. So despite a strong start last year, demand at the end of the year clearly weakened. However, there was a rebound of demand in the jewelry sector. Investment demand will be the key going forward, and cheap money should minute. This goes back to what I was just saying. Of course, if people have access to more money, they will be able to diversify their investments, and ETFs in particular tend to be key to track when it comes to precious metals and any sort of physical investment. So we can see that investments have always been the majority part, except for perhaps between 2013. Most recently, we saw a drop in, well, other than jewelry, of course, which takes precedent over everything. But we've seen a drop now in the demand of central banks, demand of investments. However, technology and jewelry have both increased, because if you're relying on them for production and the price of gold drops, you would assume that the price, or that people that are relying on that would increase their investments, or at least buy it themselves. I thought that this was an interesting chart, but now we'll move on to the share of investment demands in central banks decreased in Q4 2019, piled up over recent quarters. This is basically what I was saying relating to this chart. It just is a different way of interpreting it. Healthy demand from those buyers will be crucial for gold to recover over the next few months. Now, despite the decrease in price stimulating demand from these two sectors, which are jewelry and technology, it is essential for the price of gold to maintain stability as well in investment markets. And we can see that over the years, there's always been like a crossing relationship between the two, are the investment from central banks and the price of gold. Price increases, or as the price decreases, demand increases. Price increases, demand decreases. And nowadays, we can see that both are increasing. And if the trend continues, you know, the diversified nature of gold will continue. Because at the moment, if investments and central banks continue to sell off, and this is the only buyers, it's not going to be enough to maintain the price of gold moving forward. So healthy demand from those buyers is also crucial for gold to recover. So now, as I mentioned earlier, we're going to be comparing a little bit the situations in 2008 and 2020. I remember 2008 vaguely, but I remember the fact that there was this very widespread sense of panic in the markets, and there was this very wide sense of everybody rushing to sell. Now, in 2008, the price reversal for gold reached a maximum of 30%. So, as you can see here, gold in 2008 managed to have a very up and down swing. And at the moment, we're not heading quite in that direction, because if we look at gold right now, it's basically an increase and then a sharp decrease. Now, how we move from here, based on what I was saying, would be a stabilization, but at the same time, because we're in different circumstances at the moment, it's very hard to predict. The first wave of sales in 2008 ended at 10% and the next at 15%, so around here and around here. So these are the two waves. While right now we have a wave that is about 10%, 12%, 50%, and we'll see where it rebounds, if it rebounds, or if it could continue to fall even further than that. The rebound from ETFs caused a rise in gold prices. Of course, we see the ETFs here. So ETFs in 2008, they had demand, it dropped, it increased again, and it brought the price back up. Then it dropped again, and as you can see, they're very closely correlated charts we've seen. So ETFs tend to have a critical role in the price of gold and in the trade of gold. But we can also see that gold in 2008 at the end declined slightly. So people were rushing to buy safe haven, but we had a similar situation to now, to where cash takes precedence in these sorts of situations. And it really depends on the central banks and on the policies instituted by these central banks on how they will provide cash. Because, you know, nobody can buy, well, rarely can you buy physical things in real life with gold. So cash is obviously the prime resource everybody needs for everyday life. And if it's unavailable for several reasons, then people need to sell their other assets. As you can see, people, if they have more access to easier funding then they're more unlikely to sell, and they're actually more likely to reinvest in these assets. However, looking at the longer term, it can be seen that a lot will depend from the behavior of investment demand, mentioned, including ETFs or speculators, so traders around the world. Throughout 2008, gold fell from top to bottom over 30%, so over now, basically more than now. Later, however, we had a rally that ended with historical peaks of nearly $2,000 per ounce. And this explains a few things. People tend to buy into things that are cheap, except if something takes precedence, like I mentioned, where money cash is essential. In a situation where we come out of this crisis and the prices of gold are still cheap, last time what happened was basically there was an increase in demand for gold because there was all this money out there at this point, and people were just looking for ways to diversify and invest because they had realized that investing in bonds at the time or investing in loans backfired because of the subprime mortgage crisis, and so investing in physical assets tended to have a safer return in the longer term, which led to the rally, or was one of the reasons at least that led to the rally in gold around $2,000 we saw at one point. Here we have the levels of inventories on the COMEX exchange, so the gold, suggests that we are dealing only with a correction. On the other hand, recent consolidation has not supported a clear rebound in the last few weeks. So, before I carry on and talk about what's happening at the moment right now, this is from the 17th of March, and we can see that there had been a sharp decrease in the spot price of gold from around up here to around 1,500, so 1,500, and even dropped below that at one point. And so we can see that the inventory data, so how much gold is held, actually didn't follow the same trend of the gold price. We saw that it stabilized. So we can see that as the price decreases, you would assume two things would happen. So either the participation increases, so inventory for COMEX increases because everybody's selling gold, they would buy it. Otherwise, they would assume that it decreases because, going back to what I said earlier, the gold became a second-hand asset, not necessarily a safe haven at the time when cash takes precedence. However, what we saw was a stabilization of these figures around this level, 8.6 million. This is in part due to a few things. So, as I mentioned, the fundamentals for gold, people generally know that, or not people, but investment authorities generally know that the short sell-off in gold was to cover margin calls. So there isn't any fundamentals to panic about gold, really, or to explain an excess in demand or an excess in supply, other than people are just searching for alternatives to be able to function in the economy when it's ground to a halt, because it's almost never happened other than in times of war. So the rebound is expected to follow these kinds of patterns as well, because of the fact that there is no actual fundamental reason behind it. We can also see, when it comes to precious metals, the gold and silver ratio is completely detached. So usually they tend to follow similar patterns. However, we can see that the price of silver dropped significantly more, or significantly less, sorry, than the price of gold. So why is that? Because of the fact that basically gold is the main asset held by people. So silver is secondary. It is considered a safe haven asset, but gold is the one that most people would recognize, most people would invest in. And so that's the first thing they would be able to sell. And this is purely based, the decrease in price of gold is purely based on, mainly at least, it would be based on an increase in supply and a decrease in demand, which has been outlined in the previous slides that I made. Silver, slightly less variation on this end because of that fact, because of the fact that there is, in fact, less silver held. We can see also that following that, we had some after 2009. Basically, we had a huge spike in the price of both. I mentioned the price of gold reaching around 2000, but also the price of silver increasing and spiking. Ever since, they've been following the trends, cheaper, and gold was being out. But now they're following. Finally, we have a chart that shows the gold versus ETF holdings for short term and silver here on the right hand side. The gold, as you can see, gold has not lost as much on value as much as silver. You can see that ETFs are still calm for now. So silver, because it's a smaller, obviously, market, and the fact that it is cheaper, obviously, people tend to have less fluctuation in it. But in these kinds of situations, when they're looking for external resources, they're willing to sell everything, including silver. Gold, as a total percentage of its price, has not lost as much, but we saw a significant decrease in the price of gold, and the ETF holdings continued to stay stable, meaning that ETFs had not completely given up on the asset, meaning that they did not see fundamentals justifying the sale besides the need for cash. Silver, on the other hand, saw a huge decrease, and obviously as well a significant but noticeable ETF holding. One more chart we have is there's a strong sale of all precious metals. So we had platinum hit 17-year lows recently. However, it can be seen that the ETFs did not start the sell-off, which indicates that the speculative demand on the contracts has broken out. And it's what I mentioned earlier, is that ETFs tend to be outside the realm of everyday trading that most people do. So where people see the stock market crashing, they panic buy or they panic sell, whatever they do. ETFs tend to have more access to data. They have more long-term perspectives than your average person, and therefore, when you look at their charts and what they've been doing, you can see that it's a little bit more steady, and you can understand that sometimes ETFs might not see things the same way because they have access to historical data, and because they take that into consideration more. But back to I'll get back to the platinum, because yesterday I mentioned something about platinum itself and some news relating to that. So however, it can be seen, as I said, so we have here basically palladium, platinum, and we've mentioned gold and silver, gold, silver. So every precious metal, as you can see, silver dropping, gold dropping, or platinum, sorry, gold and palladium, all of them dropping. Some more than others. Platinum, as you can see, seems to be the steepest drop, along with silver, and gold and palladium not quite as much. And also on this, we can see on this chart instead, we can see a clear reduction in net positioning on precious metals that was occurring on the 10th, meaning the difference between buy and sell position, or long and short position. And currently the position of speculators is much lower than this. Okay, so thank you very much for your attention so far. That was the main part of the presentation. That was from about, most of the data was about last week, but now I'm about to show you a few things on the excitation chart, and I'll mention a few things that to keep in mind moving forward, and to keep in mind that are kind of updates, I would say. So, of course, if you have any questions, please don't hesitate to get in contact with your account manager or with your sales. My name is Walid Kudmani, and I am the market analyst, as I mentioned. I do the WhatsApp group, so if you have any suggestions for that, please feel free to get in touch. Now let's move on to the chart. So we'll have the excitation here, and you'll be able to see this is a gold chart on the 4-hour. So as I was mentioning, the whole presentation was about how the price of gold was dropping. Now we can see a rebound in the last, basically so the last data we had was around here, and we can see that the price stabilized around 1470-ish, and then has been increasing. The price of gold increased from the 19th to today about 11% or 11.5%. Similarly, you can see that also the price of silver has been increasing. And what does this show you? That basically, what it indicates at least, is that we have a situation where central banks intervening has actually been able to kind of stop the mass sell-off of gold, because people have actually more access to cash. And the whole point of the presentation was understanding that sometimes things that are usually considered safe haven lose their status temporarily when other things take precedence. But when conditions are, I'm not going to say normal, but at least fairly stable because of the backing from central banks, you can see that things tend to go to their usual patterns. And so with an increase of about 11%, and with an increase of about, say, similarly for about 9%, 10% for silver, we can see that as soon as central banks cut rates, implemented QE, mentioned that they were going to do everything they could, the demand for gold started to increase again, and the price for gold started to increase. Another thing that this is news from yesterday or the day before, actually, that is quite relevant, is the fact that South Africa had mentioned and had planned to shut down their mines for 21 days, at least, I would say. Because, of course, they're trying to stop the spread of coronavirus, as most countries are. And partly you would assume that mines are very packed places where people are in close quarters, and that itself is a risky environment. They decided to close that. Now, why is that relevant? Because, I don't know, some of you may know that South Africa is actually a massive exporter of precious metals, in particular platinum. In particular platinum, because last I checked the figures was South Africa is the major exporter, producer of platinum in the world. So of course, shutting down their mines was key for the production of platinum. And we can see that from yesterday, or the 23rd, we're on the 25th day. The 23rd to today, we have an increase of about 19% in the platinum market, after what I had mentioned earlier was a decrease, about 15%. So we're about where we started, but this is actually driven by, partly at least, could be driven by the fact that, of course, supply could be affected. Demand is back to similar previous levels, and the fact that, of course, people now view it as also a safe haven asset along with other precious metals. And so all these factors combined, you can see that there have been these huge swings in both the prices of gold, but as many of you know, in indices, and everything has been spiking, and volatility has been spiking because people are following what they can. And when something takes precedence over another, people will flock to that, generally speaking. And that's really what I wanted to update with at the end of the presentation, was this news about the mines and the fact that, of course, gold has been increasing. Going back to gold, we can see that now gold is around 1620, but it did reach levels around 1640 as well, from the lows that I had mentioned. And so all that combined, I think, gives you a bit of a picture of the gold market, why there was a drop in demand, why there was a drop in availability of cash. And based on all of that, I think that hopefully this presentation was useful and was helpful. And based on that, I think that moving forward, it's important to keep an eye out on a few things, meaning keep an eye out for supply and demand, and keep an eye out on the policies of governments, because depending on how easy it is to access cash, people tend to either flock to that or flock to other things. And all these things combined can kind of give you an outlook of the prices and the performance of precious metals moving forward. And so on that note, I'd like to thank everybody who was watching. If you have any questions, feel free to contact your account manager. I will continue to be posting on WhatsApp, and I hope you have a good day. Thank you very much.